So yes, we have seen the resurgence of inflation. Monetary policy looks very different today than what it was a year, 18 months ago. Real yields have been going up. I think that explains a lot of what's been happening here. You can think of the downtrend in equities, the downtrend in bonds. That's directly related to real yields. That's just the 10-year real yield derived from TIPS. Now, if I do a real simple, and this is my third and final regression of the morning, if I plot that against the Fama French value factor, so I'm explaining the monthly returns of Fama French value factor with the change in the 10-year real yield over the last 10-year period, I'm getting a R-squared of 0.13, which is not bad for a time series regression. The T-stat is 4.8, which is very, very significant. Now, there's a big argument going on about whether this is whether there's any causation here, whether it's just a fluke. But I think empirically, what we can say is that there's been a very, very close tracking between the value factor and real yields in the recent past. So a few more points then in terms of that paradigm shift. So I think what the rise in real yields will do, and is doing already, is that it's really creating a stress test for business models that have relied on ample use of leverage. Secondly, equity bond correlation looks very different now than it has done for the last 20 years, and that has to do with the inflation environment. And so the diversification you used to get from bonds hasn't really been there in recent past. It may come back, but I think that would require the inflation environment to settle down quite drastically from where we are today. And finally, liquidity is all of a sudden back in vogue. So investors need liquidity, will consider liquidity in a very, very different fashion to how they have done it. And I think in that environment, the rebound in alternative risk premia may mean commercially that we will see a rebound also in the investor interest, manager interest in these strategies.